All right, there's a really big tax change for a very small deduction that's going to impact a lot of you. Let's talk about it. I've got details coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. All right, there's some changes with the Universal Charitable Tax Deduction. What in the world is that? I'm going to explain it right now, and then we're going to talk about how these changes take place for 2021 and how it could impact you. First, the Universal Charitable Tax Deduction. It's a new deduction that was part of one of the stimulus packages, and it created a tax deduction for 2020 and for 2021, both of those tax years, and then it's done. That's it. And will they make it permanent? I have no idea. They're trying to change all sorts of things with taxes these days, but right now it's just for these 2 years. And what it meant is, if you make charitable donations and you itemize your taxes, fabulous. You get to claim your charitable deduction when you itemize, and you're all set. And that makes you not eligible for this universal charitable tax deduction. But if you don't itemize your taxes, and there's a whole host of people that are no longer itemizing thanks to the doubling, pretty much, of the standard deduction thanks to the Trump tax cuts. But that means more and more and more people are not itemizing. So if you make a little charitable contribution, there's no deduction for it until this universal charitable tax deduction. And so for 2020, that deduction was $300. For individual or family, doesn't matter, $300. So again, this is small. It's a relatively small thing, but I still pick up pennies in the parking lot. So, if you're eligible for this thing, you better take advantage of it. And so this year for 2021, instead of $300, it's $600. Okay, the same limit. That's individual or joint, doesn't matter. It's gone from $300 to $600. Why the complication? Make it $600. Period. Should have been that way for last year too. I don't know why adding this extra. I mean, that doesn't make any sense. I don't think they garnered any additional votes. I really don't, because they had the first year at 300 and not 600. Dumb, in my opinion. Okay. So anyway, but the positioning of this deduction on your tax return, that's the big change to this tiny deduction. Okay, last year for 2020, this was a above the line deduction. So this $300 deduction was above the line, meaning it occurred and reduced your adjusted gross income. Fantastic, okay? And then your adjusted gross income is used to calculate all sorts of things, okay? It's also used if you live in a state that has state taxes. Typically, your adjusted gross income is what carries forward to your state return, and your state taxes are calculated out of that. So for some of you, it benefited your state tax return. For others, like in Indiana, you had to add it back, and so it didn't play a role. But this was an above-the-line tax deduction, so it reduced your adjusted gross income and therefore benefited some of the calculation. Very helpful last year because some stimulus was based off of your adjusted gross income. And there, of course, is whether you're eligible to contribute to a deductible IRA, whether you can do a Roth IRA or need to consider backdoor, whether you're eligible for American Opportunity Tax Credit, whether you're eligible for the full child tax credit, all sorts of things are based off of your adjusted gross income. So this was above the line, reduced that adjusted gross income. Fabulous. Why am I focusing on that so much? Well, Captain Obvious, the fact is this year, as we're getting a look at the initial drafts of the 1040 tax return, it's now below the line. They moved the deduction from above the line to below the line, meaning they moved it from a deduction to your to arrive at your adjusted gross income, and now it's a deduction from your adjusted gross income. So this $600 deduction this year doesn't help with your adjusted gross income. Okay, wow, that's confusing. But what it means is this doesn't help you get more eligible to contribute to a IRA. or to a Roth IRA, or doesn't make you more eligible for certain tax credits or other tax deductions, it's still going to help you on your federal taxes, but it could make you more or less eligible for some of these other benefits. Does that make sense? So last year it helped reduce your adjusted gross income. This year it does not. Is this $300 swing going to really impact a lot of you? No. And will it for those of you that it does, is it going to impact thousands of dollars, even hundreds of dollars? No. It could impact $25, could impact $60. I mean, there will be some changes here. Might not be a meaningful amount, but still noteworthy difference. And for those of you that are careful about your adjusted gross income because you're trying to calculate your premium tax credits for health insurance, trying to determine if you can get some of that American Opportunity Tax Credit, something like that, you're going to want to be aware of this difference as you do your tax planning to consider, well, should we fund more HSA? Should we contribute a little bit more to the 401k? What other adjustments should we make? So work with your CFP on that. As a reminder, I didn't mention it earlier, donations, physical donations to Goodwill or Salvation Army, something like that, volunteering your time, that does not count towards this. Those things count towards the charitable itemized deduction, but doesn't count towards this universal deduction. So you've got to be donating or contributing cash. It's got to be a cash transaction to qualify for or cash, I mean, obviously debit card, credit card, that sort of thing. You know what I mean. Can't be a tangible item or volunteering your time in order to qualify for this universal charitable tax deduction. So work with your CFP on that. Hopefully you are doing proactive tax planning right now. You should be doing proactive tax planning all throughout the year. How geeky is that? That's why you need someone like me, because we love it. We absolutely love looking at all the ways that you can improve your tax situation and then helping you determine, well, which of those strategies do you implement and which of those do you let pass by because of other priorities in your financial life. Work with your CFP on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com, that's Korhorn with a K, wisemoneyshow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.